Hi, my name is Mark and I teach economics. In this video, we're going to be talking about three really exciting topics. So hold on. We're going to be talking about taxes, math, and gasoline. This is probably, I know, one of the best subjects that you want to study. We're going to look at tax incident and how to identify this on an exam, because you'll probably have something like this on your next quiz or exam. And we're going to use it in the context of looking at gasoline prices, and we're going to throw some math in there. So here we go. The good news is I've only got two graphs for you today and one definition, one main definition. Tax incidence is the division of the tax burden between the buyers and the sellers in a market. So we're looking at how much the consumer pays, how much the producer pays, and we're also going to throw an added spin, what's the deadweight loss? So you're going to see a graph, and on an exam you're going to have to identify what the producer pays, what the consumer pays, and what the deadweight loss is. Also, you're going to look at the tax revenue, what the benefit is to the government. So if we have three losers, consumers, producers, and society as a whole through deadweight loss, you have one gainer, and that's the government. They get more taxes. So let's take a look at this. This is the first graph. This is the most important graph. I promised only two graphs today. And this shows at point A, market equilibrium. Supply and demand intersecting for a price of $2 per gallon before any kind of tax. And I've got a quantity of 155 billion gallons consumed each year, consumed each year. Now, if the government were to impose a 10-cent tax on gasoline, and this will shift the supply curve to the left, but automatically the consumer doesn't pay the 10 cents. The pump, you'll see this, at the pump, he'll see 208 in this instance. The demand curve for gasoline is relatively inelastic. That means it basically is a vertical slope because people demand gasoline and they're not going to change consumption. They're not going to stop driving to work and taking bicycles. Unless you're in California, maybe they do it anyway. So a lot of the burden is shifted to the consumer. In this case, you see the supply curve shift from A to B, and the intersection point is at 208 for gasoline to the consumer. And this is a difference of 8 cents from the point A, market equilibrium. Now, point C is what the actual producer has to pay. After taxes, he'll get $1.98. So his burden is 2 cents. And then you can see in yellow what society pays as a whole, the loss that nobody's going to get back. It's deadweight loss. We see this with market intervention, government intervention in the market. It's a distortion of the market. So the price for a tax, yes, there's deadweight loss, but the consumer and the producer also pay. So if the question is, what happens with a 10-cent tax on gas, you've got to be able to draw this shift, and you've got to be able to identify the math. It's just simple arithmetic. And how much of that 10 cents the consumer pays and how much does the producer pay? Now the question is, does it matter? Does it matter if it goes to the consumer or the producer, the tax, the producers, the guy who sends in the tax receipts? I think it's easier for the government to put it on the producer because they just simply, Exxon Mobil or whoever has to just write the check. But, if you were to have to write the check every time you go to the gas pump, it's a different story. But let's just take a look. Let's take a look at a 10-cent tax from a consumer perspective, a consumer shift. So the burden is on the actual consumer this time to send in the receipts. Voila. There's no difference in the quantity demanded per year. It changes from 155 to 150. The shift amount is the same. And similarly, the consumer still pays 208 and the producer gets 198. So the 10-cent tax burden is actually split. The incidence is split exactly as if it was on the burden, at least in the terms of the receipt, on the producer. And there you have it. consumer or producer has to send in the receipts, it's the same. Now, granted, maybe the slopes of these supply and demand curves are not perfect, but you get the point, and it could be a question. But most important, you have to identify where the deadweight loss is, what the consumer pays, what the producer pays, and how much tax revenue the government gets. And you can do that with simple arithmetic. You have triangles and rectangles, and you can take height and width and multiply them out. And if it's a triangle, you can use some division, and there you have it. So again, in this video, we looked at tax incident, and that's split between the buyer and the seller, and you should be able to identify it now. So I hope you liked it. It's a short video, 2 graphs as promised. And again, great topic: gas, math, and taxes. Thank you.